What's going on, traders? It's Lucas here from Commitment FX. Thank you so much for joining me. Today we're going to be going back to basics. I've had a lot of requests from my subscribers and my club members over on the Commitment of Traders Club asking me to do a very basic video on how to trade Forex, a beginner's guide. So shout out to Vinjenko for the suggestion of this video. So let's get straight into the video. Let's go. So if you are a beginner trader, you'll be looking at this chart which I have in front of me and you will not know where to start. I know when I first started it can be complicated. So let's break it down. How do we start? How do we enter? And where do we finish? Let's first identify how Forex actually works. So when you log on to your broker, and I suggest that you investigate which brokers are best for you, I also suggest you use a platform called TradingView, which is what you're seeing in front of you right now. It's a broad spectrum of markets you can analyze, draw on the charts, and even connect your broker to it. So when you're looking at the charts, it's very difficult to understand where to start. The first thing you're going to need to do is you're going to need to get a broker to get access to the market. For me personally, I use one called Oanda. I think they do the job perfectly fine, but you should suggest that you go and find your own broker, do some research, see which ones work for you. And then when you log on to your broker, the first thing that you're going to see is a menu which will look something like this. And what you're looking out for is CFDs and spread betting. CFD stands for contract for difference. Spread betting and CFD are very similar. Spread betting is available for UK members only, and it basically allows for some tax reliefs here and there, but they both do the same thing. They allow you to trade Forex. So you're going to want to open an account using a CFD or a spread betting account, whichever is available to you. There's no material difference really. First thing I would suggest is start with a demo account. There's no point plowing your money straight away into the market if you've not even understood how the market works yet. So that's the first thing I suggest you guys do. Open a demo account and get a handle on what the chart and the Forex market is actually all about. So that's my first top tip, open a demo account. So once you've opened a demo account and you've logged into TradingView and you've logged into your broker, what you will see is something like this. And this is what we call the trading chart. We've got all different currency pairs. And the first problem you're going to have is identify which pairs you're going to do. So let's break it down. Let's identify which ones you should be using. So over here on the right, I've got my watch list, or as I call it, my trading list. The pairs that I like to watch, that I follow, and that I trade with. Let's think of it a little bit like Twitter or Facebook or Snapchat, or whatever platform you guys use these days. And these are the pairs that you're going to follow and know inside out. You want to understand how they behave and the characteristics between them. The most traded pair is Euro USD, which I have in front of me now. And what we're seeing here is the price movement over a several period of time between the Euro and the US dollar. And when you're trading Euro US dollar, you're either buying the Euro and selling the dollar counterpart, or you're selling the Euro and buying the dollar. That allows you to enter the market either to buy or to sell. Unlike some platforms which deal with shares, let's say an ISA account, for example, you can only buy a certain asset. In Forex trading, you can make money by buying or selling the asset at any time. Let's say, for example, we're in a downwards trend here. If this was a share, you wouldn't want to buy if the market was collapsing. Well, that's not how Forex works. Forex, you can profit from a downwards trending market. You simply add an order to sell in which you are buying US dollar and selling Euro, because that's what we're trading here. And then you can profit on where you close out the trade. You're buying the gap between the price at which you bought or sold it and the price at which you're closing out. That's how you're going to be making money in Forex. Up the top here, we've got the time frames. Now, I'll give you a second. I'm going to flick through the time frames. There we go. And you're going to tell me that, Lucas, they all look different. Well, they do all look different, but they're telling you exactly the same thing. If I'm looking at this here on the daily, which is what I am looking at now, each candle, which is what we call these things here, these are called candles, is created over a 1 day period. So by the end of today, this candle here will have completed and it will look something like the candles on the left. Now, if we zoom in, and we're going to zoom in the chart, we're looking now at 4 hours. Let's remove this. So each candle here is now showing price increase and decrease over a 4-hour period. That means these candles here, 1, 2, 3, 4, created what we saw here on the daily candle. So they are all correlated and they all tell you the same data, but just at a different perspective. Zooming that in on the 1 hour, you've got here 24 candles here will make up one daily candle. And you can even zoom this in further. Let's say, for example, 5 minute, each candle here is created after 5 minutes. And you can tell that this candle pattern chart here is completely different from what's going on the daily. They have no pattern in terms of that they're showing you the same thing, because this is over a broader period. We're looking back here all the way to 2018. But if I go back on the 5 minute chart, we're looking back here the 21st of December. So just over 10 days ago. So you need to identify which pattern or chart time frame you're going to be looking at. I suggest you look at the videos that I have posted below. I'll link them above if possible, but check through my channel to see which time frames I think you should be using as a beginner trader, and I'll show you why in those videos as well. So now you've identified that the chart actually tells you different things depending on which option you select. We're going to be looking at it today on the daily. I like it, it's more of a cleaner chart pattern. So what is a candle? You'll hear me talk about candles. I'm not talking about ones that you burn that make your room smell nice. I'm talking about candle patterns on the chart. Now, most of you, if you use an iPhone and you use the emojis, you'll see the little line bar. Well, we can change that to the line bar by clicking an option. The line bar doesn't really tell us as much information as we want to know. This tells us that at the moment the price is in a downwards trend. We're moving downwards, but that's all it's going to tell us. It's not going to tell us any more information. So what we do is we switch it to the candle chart. And zooming it in further, each candle tells us a particular piece of data entry. Okay, so what we have here is we have the body of the candle, which is the bigger bit. Then we have the wick at the top and the wick at the bottom. So you've got the body, the upper wick and the lower wick. So it's a candle. And what it is telling us, so let's say this candle's closed here, the candle will open like this. And as price moves up, the candle will grow bigger. As price moves back down, the candle will shrink and perhaps come a little bit further down. And eventually it will close. Excuse my art, I'm doing this on a mouse. So it will close, looking something very square. And what will happen here is the price will have maybe pushed up further, it may have pushed down further. But the open and the close are shown within the candle body. So we can see here, and I'll zoom this in much more. Currently where we're trading, price was in an upwards trend, so it closed here. The next candle opened at this area here. It pushed up, price pushed up, then it pushed all the way back down before finding closure in and around this area. So what the candle is telling us is that price actually opened and closed, but price moved higher or lower than where it opened and closed. And that's very important to get your head around why it is showing us this. Let's say, for example, and you can see they're all different sizes. Let's say, for example, we've got this candle here. It's got a very large wick to the upside and a very large wick to the downside. And what that is telling us is that there is buying pressure and selling pressure in the market. When price moves up, and again, we're looking at it on the daily, when price moves up, lots of people who are looking to sell this pair start putting their orders in. And that then causes price to move back down. Well, then it moves and closes down here. And people who are looking to buy this aren't happy with that. So they put in a buy order. And that then causes price to move back up until time of the day runs out and it closes around here. I hope that makes sense for you guys there. Happy to do a separate video on candlesticks in the future. But what you need to understand is that the body of the candle and the wick are very important. If you've got a candle like this, an indecision candle, it opened and closed almost identical to where it opened or closed where it opened. And then you've got the massive wick to the bottom. This tells us that price attempted to push down, it attempted to fall off, but buyers stepped in the market and pushed it up and caused it to close roundabouts where it opened. It's a very powerful candlestick formation. Check some of my videos to understand why I like to trade them as well. So this is what a candle is in Forex. So zooming this out now that we understand, what we have here is a chart filled with each and every individual candle, and they're all different in size, shapes and data which they're telling us. So that is what you need to understand, the importance of the candle. Now that you do understand it and you can see how they're represented on the chart, you've understood the basics of what the chart is actually attempting to show you. The next thing we need to do is understand what actually is happening. So what we have here on the side is this is the price along the side, and I am doing this very basic. This video might not be for those intermediate traders out there, but for those beginners, this is the price on the side. And at the moment, price is around 1.130 Euro USD. Okay, and each move upwards or downwards is called a pip. So let's zoom this in a little bit, we'll be able to see it clearly. So each one is called a pip, just like an apple pip or a pip in a melon. Each one is called a pip. So we can see here that this candle, from where its highest point was to its lowest point, was 13.7 pips. You can see that over there on the right, 13.7 pips. So points or pips as we refer it, and that's just a price move. So each move is measured by a pip. When you click buy or sell on your broker account, it will tell you the pip value, and the pip value is dependent on your account size. If you've got a small account and you're trading with £100, your pip value might be 0.01, so 1 penny a pip. So if price moves 100 pips, you've made yourself your first pound. If your account size is £10,000, let's say, 1 pip might be worth £5. So if you've got a move of £100, you've made yourself a nice, tasty £500. So depending on what account size you've got, a pip value will change, and you'll see that on your broker's account when you're demo trading. So now that we understand what a pip is, we understand what a candlestick formation is, what the chart is actually telling us, well, that gets us to the next question. Okay, I know what it's doing, but how do we trade Forex? And that is where the best bit of this strategy and this tutorial comes into play. So let's zoom this back out. Again, we're going to use one of my favorite patterns, chart time frames, which is the 4 hour and the daily. So we'll look at it on the daily to start with. So zooming out, you've identified now, you understand what's going on, I should hope anyway. Meet me in the comments if you are still having any difficulties. So now you've understood what is going on and what the chart is telling you. How the bloody hell do you make money on this? Because I've heard myself you can make some good money on this, of course. That's why we're all here. And we can make some good money on it if you trade it correctly. Well, let's get straight into it. The first problem is you are going to lose money. You are all going to lose money trading Forex. And I'll keep that very straight to the point. I trade with this channel in the most transparent way I can. You will lose money trading Forex because that is the aim of the game. We are the small fish in this community. The bigger fish, the banks, the institutions, they are the ones making the most amount of money. Let's log on to a different broker. Let's use, for example, CMC Market. Let's log on to their website. And all of you, no matter which broker you click on, you will receive a message at the top. 66% of retail investors, that's you, will lose money when spread betting and or trading CFDs with this provider. And that's nothing to do with the provider. Don't be put off and say, well, why should I use this broker? Most people lose money. It's nothing to do with the provider. That works with every single trading broker, mine included. Why is that? Because we are bound to lose money. We are entering a market which we shouldn't really be playing in. This is a market for institutional traders, big banks, hedge funds, pension funds. They are the big players in this game. So the first thing you need to do when trading Forex is understand that you are going to lose money, and you're constantly trying to find ways not to lose money. You're not in this game to make money, you're in this game to lose money. But the trick is trying to beat that losing trade. Because 66% of you are going to lose, apparently. Well, not if you watch my videos, you're not. So what I suggest you do is, first of all, head over to my website, commitmentoftradersclub.com. I publish what's called the Commitment of Traders Reports. And that tells us, and we'll go over there now, that tells you the positions, and I've got it in a nice chart, you won't find this elsewhere. That tells us the positions that banks and institutions have, whether they're buying or selling a particular currency pair. Here, for example, we've got the Australian dollar. We can see that overall they're looking to sell the Australian dollar. we'll go over onto the Australian dollar chart. And we can see that from the 15th of March, price has been moving to the downside. Would you have known that? No, you would not. You need to understand, first of all, what the banks and institutions are doing in this game. Check out my previous videos as well. So once we understand that and we've understood the risk, now we can finally look to trade. So the name of the game is entering the market at the perfect point. All markets, some do it better than others, move something like this. You'll see this is a standard line chart. And what we have here is we have an impulse to the upside. Then we have the push to the downside, which is what we call the retracement or the pullback. Then we have a continuation to the upside. Then we have the pullback. Then we have the continuation, the pullback, and then the continuation to the upside. Now let me draw this on again here for you. I'm going to draw it on again. And what I want you guys to do, whether you do it in your heads or if you want to put it in the comments, whichever you'd prefer, tell me where you would like to enter this trade. So the market's moving to the upside. We're only looking to buy this market. You always go with the trend. If you counter trend trade, so if you sell in a buy market, you're going to lose your money even quicker. So you always want to trade with the trend. So if the market is moving upwards, you're looking to buy it. If the market's moving downwards, you're looking to sell it. So tell me, where would you look to buy this particular trend? I'll show you where you're looking to buy it. You are looking to buy it at the pullback. This is the name of the game. You are looking to buy the trend at the deepest point possible, because that will give you the best run up to the next impulse to the upside, where you'll look to close out, or if you're looking to long term, for it to continue on eventually. So you're looking to buy into the Forex market at these pullback zones. That is the name of the game. Now that's easier said than done, unfortunately, otherwise we would all be millionaires, anyone who traded Forex. But a particular pair, and here's a free top tip that I like to use. USD JPY, the United States dollar against the Japanese yen, is a very nice pair which trades and trends over a very long period of time. Let's have a look here. So from this time last year, end of December 2020, the whole year, the market has been moving to the upside in a very nice clean trend. The same goes from back here, 25th of March 2020. The market for most of the year made a very nice trend to the downside. So now we've identified that the market is actually trending in a particular direction. It makes it much easier to look to when we're going to buy. So following on from my analysis previously, we're in an upwards trend. We want to buy at pullback. So looking at the chart, let's get rid of this. Where would you think it'd be necessary to buy? Well, I'll show you. First of all, we've had this impulse to the upside, which is formed up here. This is what's called a higher high, because we're moving upwards. It's created here's a high, this is a higher high. Then we have the retracement or the pullback, and we will enter at this point, because then the market is moving higher, price is getting more expensive, and we are going to make more money from the difference in that price. And where do we close out? We close once it makes a higher high. We've closed out, fantastic. We're going to look to enter again. Price pushes back to the downside, makes a retracement or a pullback, creates a higher low. Why is it a higher low? Well, here's the low. This one's simply higher, so it's called a higher low. Where do we enter? We enter there. Where do we close out? Once it's made a higher high. And we can do this over and over again. Here is a lower high. Here's a higher high. That's where we close out. Here's a lower high. A higher low. We've not made that higher high, so you'd still be in this trade. Essentially, that is how you're looking to trade Forex. You're looking to enter the market at the lowest point possible to capitalize on that big move. Let's look at this in a downwards trend for anyone who just needs to see that. I know visually it can help. So we're trading here in a downwards trend. So what we're looking for in a downwards trend, we've got the impulse. Here's the retracement or the pullback. There's the continuation. Here's the retracement and there's the continuation. So you've got a low, then you've got a lower high. So you flip the terms. Then you've got here a lower low, And then you've got here a lower high. So we've got a lower high, excuse my artwork here, and then we've got here a lower low. And we've got here a lower high because it's lower than the other high. That's as simple as that. And then we've got a lower low because it's lower than the previous low. Very easy. So let's look at this chart here. So we've got the impulse to the downside, which is coming down here. Here is our lower low. We don't want to enter there because the market is going to make a pullback. It always moves in waves. The market always moves in waves. So we don't want to enter at the lowest point because you're going to lose money before you're going to make the next lot. So we enter then at the lower high. So we enter our trade there. Market pushes to the downside. Fantastic. You've made some profit. You close out at the lower low. You wait patiently for the market to create a lower high. It's a high. It's lower than that high, so it's a lower high. You enter at this point, and then you wait for the market to create a lower low, and you close out. And you do it again. You wait for the market to push up. It creates a lower high. You enter the trade, and you close out at the lower low. Now, isn't that easy? It's super easy. It is very easy to look back on the chart and do it with hindsight on your side. Doing it in the live market is a little bit more difficult. Check out my videos on my channel for tips and tricks as to how to identify the right times to enter, because that is the name of the game. We know the trend. We know what the banks are doing if you're a member of my club. So then we just need to work out, well, when does the pullback end? That's all you're waiting for. You're waiting for the pullback to end. That's the trick that you're going to be doing. That's what trading is. Waiting for that pullback to end so you get the best entry into the market for the market to then move to the downside. So you're making money from a market that's selling or buying. Don't forget that. So we'll stick with this pair. Let's see then, how do you actually enter the trade and the things that you need to be cautious of, which is called risk management. So what we need to do is when we enter a trade, you need to have what's called a target and a stop loss. Anyone who tells you not to use a stop loss is crazy. So what we do on TradingView, you can go on to the left. We've got a long position and a short position. This is just simulating a trade. So let's follow on from what we did before. So we're in an upwards market. Well, Lucas, how do you know we're in an upwards market? Very easy. You can see that very clearly. That's an upwards market. It's created a high. Then it created a higher low, then a higher high. That's how we're identifying it. If the market is moving upwards in waves, you can see that. And zoom your chart out. For beginner traders out there, I don't recommend you use anything like the 15-minute, the 30-minute time frame, even the 1 hour, because it can get very complicated. Using the 4-hour and the daily time frame will allow you to see the market in its true perspective, whether it is trending upwards or trending downwards. So that's what I suggest you do. So we're in an upwards trend. We've identified that. And what we're going to do is we've found our entry. We've looked at Lucas's videos. We've looked at Commitment FX videos. And we know that the market is going to push to the upside at this point. This is where the pullback has ended. For those of you, here is our higher high. The market is in the retracement to the downside. The retracement and the pullback, same thing. And we've now created a higher low. Here was our low, here's our higher low. So we're going to enter. This gives us the best run up to the market. We're going to put in an order, which will look something like this. And when you're on your trading panel, on your broker, this will all make sense. So we're going to set a target. Well, what target we're going to set? I suggest you do 1 to 3. You risk 1% of your account to make 3%. That way you can be wrong 7 times and you're still making money. Think about that for a second. So you've set your target. Let's say we're going to aim for a target. We're going to look to the left. We're going to aim for a target where price has been before. Price likes to go where it's been before. Price is something of a habit. It does the same thing it does before. So we're going to set our target up there. That makes a good common sense. Now, where do we put our stop loss? Well, you could have your stop loss all the way down here. And this way you can set your stop loss on your broker that you only lose a certain amount of money or a certain percentage of your account. But this way you're trading at not even a 1-to-1. So if you're risking, let's say you had £100, if you're risking a pound or £10, whatever you want, you're only going to be making £8. So if you keep playing like that and you keep losing, you're going to be burnt out. So what you want to do is you want to have your risk to reward about 1 to 3. So you drop your stop loss, which is what this red thing is here, to around a comfortable level where you'll work that out. You'll be able to check my videos out for why you should enter a stop loss at a particular point. And then the market moves to the upside and automatically cuts you out when it hits the target. Fantastic. You can sit there at the beach, you can make a sandwich, whatever you want to do. You are getting cut out of that market, cash money into your trading account. Beautiful. And the best thing is, let's say, for example, you've not done your research properly in the market. Although it's trading upwards, you want to sell this particular pair. So you put a sell order here. And notice how the colors are flipped. And you've got your target down there. It doesn't matter. And you've got your stop loss. I don't need a stop loss. What happens? The market moves against you. Sooner or later, you've lost all of your money. So do not do that. What you want to do instead is you want to put a stop loss order, which is at a comfortable level, usually above any previous structure. And that'll make more sense if you watch some of my other videos. So that if you are wrong, and by all means, we are always wrong in the market. It is not uncommon to be wrong. So do not be disheartened if you take a trade and it goes against you. It's just what happens sometimes. But if you are wrong, you set your risk. You're only going to risk £10, £20. If you've got a big account, £1,000, and then you're out. And that's it. Cuts you out, your broker kicks you out, and you're out of the trade. Move on to the next one. So always set a stop loss when you're trading, because if you are wrong, you're not going to blow your account. So traders, I think that will sum up the beginner's guide to trading Forex, all the way from identifying a broker, identifying your pairs, what the chart is telling you, how the chart works, and then buying and selling into the market, and where to put a stop loss order and your take profit. If you do want to find out more, I've got some videos on my channel, Commitment FX, in which you'll find some fantastic information about the advanced intermediary trading strategies out there. But please take one thing away from this video. You have to be comfortable with losing money in Forex, because unfortunately you will at some point. But Forex can be a very lucrative trading platform as long as you understand what's going on, trade with the banks, join my club if you'd like to understand that better, and then you can make some serious money trading Forex. In any event, traders, thank you so much for watching the video to the end. Have a very happy new year. I will see you guys in the new year for the next video, and we'll see you next time. Bye bye.